Maybe I can use an analogy
Yeah.
to describe this, and that is, think of what we're doing as buying beach balls that are being pushed underwater and the water level is rising. The faster the water level rises, the more you're willing to hang in there, and particularly if the beach ball stays down. So what I'm saying is that Pfizer starts to look a little bit more like a moving sidewalk than it does an escalator when you look at the forward product categories and what's rolling off of patents as well as what's coming down the pike. Next one is the investment process of the shareholder, of the management of the company. And conceptually, if you think about what you're doing when you buy an equity, is you're buying two cash flows generally. One is the cash flow that is given out as form of a dividend, and the other is the cash flow that is retained by the management and reinvested in your behalf. That's the wild card. And as the longer term your investment horizon is, the more important that part of the investment equation becomes, because it can affect rates of return over long periods of time. In a way, think of it just like you'd think of a stock as a bond, and that's the way we think of it.
Hello, my fellow investors. I just now played ad for you a video of Don Yacktman giving an analogy about his investment philosophy and strategy of a beach ball riding the tide and an escalator versus a sidewalk. And he says you have to view stocks as bonds. So what exactly does he mean by these analogies? What's behind it? So what we have to understand that every great value investor who uses a single strategy, like unlike investors like Warren Buffett or Peter Lynch who use a wide range of strategies, some investors they very fixated on one certain kind of strategy. And when they're fixated on one certain strategy, it's derived from some kind of philosophy that they have. So they have some kind of philosophy, and that's how they made their investment strategy, and they stick to it for years and years and decades. So to understand Don Yacktman's investment philosophy, you have to first understand his goals. So I'll play you out a video, what's his goals, and then I'll try to explain his philosophy, and then we'll get to understand his strategy.
Well, Don, you're one of those rare individuals who has an excellent long-term record, despite all the ups and downs. So, obvious question, what's your approach? I think your son called it dumpster diving. How you probably have a more eloquent way of describing it.
Well, I think the approach follows our goals. The first goal is to protect our clients' money and grow it. But protecting really involves two things. One is avoiding making bad decisions, and that will protect you on short-term problems. But if you don't do something and be proactive, then I think you're opening yourself up to inflation, which is a long-term problem in a papered society. So that the first goal is protecting the money, and the second one is to earn equity-type returns, double-digit returns over time. And the third one is to beat the S&P 500 from one market peak to the next market peak. We think that's the best way to measure a manager. And
so over here he explains his goals. Number one goal is to protect the client's money. And for that he can't invest in bad investments, and he also has to invest, if not he'll lose to inflation. So we can see over here already his first, a major part of his philosophy is low risk and to protect from inflation. So after we understand his goals, we can understand his philosophy. What he means by the beach balls is he wants a company that's always riding the tide. It's always on top. So the beach ball is a company, and the tide is like everything is going on with the market. And if the beach ball is underwater, which means it's undervalued, you would very much want to hold it. The more it's undervalued, the more you would like to hold it. The second the beach ball starts to float up and it becomes overvalued, he doesn't mind to sell it. So that's the beach ball analogy. He wants a company that's riding the tide. So if no matter what the market would throw at the company, if it will be a crisis, if it will be high inflation, high interest rates, whatever it is, the beach ball would always be running the top. He doesn't want a company that could all of a sudden sink for any bad reason. And as long as the beach ball is riding the tide and it's underwater, he'll hold the company. If it's already starts flying up, it's overvalued, he might sell it. If he watches interviews, his lectures, he says he sells companies if they become overvalued. And that's exactly what he means by the escalator versus the sidewalk. He wants the company to be going up. The future earnings, the future growth that you get from the company, the returns, is going up and not just going sideways like a sidewalk. And what does he mean by viewing stocks as bonds? So what he means by that is, and you can see it in his interviews, he explains that every company you buy, you're getting the dividends, and some of the money is staying inside in the company. It's retained earnings. And just like when you're buying a bond, you're getting the coupons the whole time, and in the end, after 20, 30 years, you're going to get back all the principal. The same thing is about a company. You're getting the return dividends to you. That's like the coupons. But you have to look at the next 20, 30 years of the company, what's going to be, in the end, all the principal you're going to get back. That's what he means by viewing stocks as bonds. So that's his philosophy. But now we have to send his investment strategy. So he wants the low risk. He doesn't want to lose his clients' money. And by not losing it, first of all, is not doing bad investments. And second of all, you have to do investments that you wouldn't lose from inflation. So his philosophy is you want low risk with, first of all, mean good companies. And I'll play you soon the videos. He explains what's a good company, what's a good investment. So he wants great companies that's a low risk. That's the first thing. And the second thing is, because he wants low risk, that's one of his main principles, main philosophies, he wants a company that's very easy to project its future earnings. So he would rather buy a company that's easier to project the future earnings, although they might have low returns, than a company that might have high returns, but has a lower projectable. It's hard for him to project. It's a bigger variation of outcomes that could be. That's his number one thing. His number two, he wants dividends. He wants as much predictability as possible. So if the company is giving him high dividends, he knows what he's getting back. So unlike, let's say, like investors like Chuck Ackrey, who would want the company to retain all the earnings so they could reinvest it and it'd be a compounding machine, he wants the dividends. He wants to take of himself and he reinvests the dividends. As more as the company earnings, as more as his returns are easier to project, the more he wants the company. And the third thing, because he wants a good business and low risk, so he wants it to be a company that's it's saved from inflation. Inflation wouldn't be a big risk for it. So he wants also a good business that could hike up prices as inflation goes on. And I'll pretty much assume that he wouldn't buy cyclical companies. He wants always the beach ball to be riding the top of the tide and not going underwater. That's the way I understand him, but I don't know. So I'm going to play you out a few more clips of him explaining his business strategy. What does he do? And afterwards, I'll also add on a few more short clips of great takeaways that I had from all his interviews that I saw. So here it is.
So with that in mind, how do you invest money? And we're going to talk about each one of these three things in the investment strategy. First one we'll take is good business. And several years ago, I thought about this and thought that there was really a way to look at, maybe create a grid and then position every company on this grid, or the components that make up a company, so that one could really get an idea what the business model was all about. Because ultimately, this business boils down to what you buy and what you pay for it. So the business model is very, very important. And in analyzing the business model, you'll notice that there are certain things that make sense to us. And what we're looking for are businesses that have what I call high ROTAs, return on tangible assets. And as an example, we put in here, or I put in here, 4 different categories. And that category, the one that hits the jackpot, if you will, or the consumer staples. You think about it, these kind of businesses where they can have a product or a service that's relatively disposable and low price, so it's used up on a regular basis, has an edge because they can manage their capital much more efficiently. They can keep it working all the time. And so when you can keep the capital working all the time, and particularly if you have a high market share, you can make a lot of money. A company that has a 40% share of the market doesn't make twice what a company has a 20% share of. They'll make 4 times as much. So having a big market share is also important, as well as having a low-cost position, but they all start to come together if you think about it. All those things start to work together. Years ago, before the meeting, I was talking a little bit, and I started talking about comparing two businesses that were basically no-growth businesses for decades, the automobile business and the cigarette business, and Philip Morris and General Motors. But if you look at the business models, they're night and day different, even though they're both in virtually no-growth business. And so as a result of that, Philip Morris has been a spectacular investment. General Motors went bankrupt. So over a long period of time, you start to see the impact of this. I guess the ultimate is the fellow who went to his 25th class reunion for the Harvard Business School. And he walked in and he said, "Joe, we haven't seen you for 25 years. Where have you been?" And he said, "Well," he said, "you know, I barely got in here." He said, "I had to work and work and work just to graduate." He said, "So I knew I couldn't compete with you guys in your fancy jobs in consulting and finance in Boston and New York." He said, "I went back to a little town in Illinois that I came from." He says, "But we did develop this little product and we did patent it." And he said, "You guys probably use it every day." He said, "We make it for $1 and we sell it for $4. I said, "You'd be amazed how that 3% adds up." Now, he may not have got the math right, but he got the concept right, okay? That's a good business when you can have that situation. Contrast that to businesses that are over here in the capital goods area. Not that there aren't some businesses that have done well, but I was thinking the other day, like John Deere, for instance, is an example. Many years ago when I was looking at the tractor business, I think the life cycle is like 17 years for tractors. How would you like to be in a business where somebody bought your product every 17 years? Okay? Think about that versus somebody who makes toothpaste. Okay? It's a lot different situation. The airline business, a lot of people have talked about how bad the airline business is and how it hasn't made any money since the Kitty Hawk. I think at one time, the airline business, it took $1 of capital to generate 40 cents of revenue. That's just not a good business, okay? But again, it's a matter of looking at the total composition of the business, in my mind. In other words, one really needs to understand what they own. What kind of business? Is this the kind of business that makes sense? Is it a good business, ultimately? So some of the characteristics are listed there. But again, we've talked about them. Now, sometimes you can go kind of in between where you have something more ad-driven, like a media business, where there's more economic sensitivity but low capital requirements. There also may be more ease of entry in the business. Because of that, service businesses tend to have that characteristic. Or the other way, where you have more capital required, like a utility type model, and some of those will work. But remember, like in the utility model, the only way to get your ROE up, because you have a low ROA, is to leverage it. You have steady cash flows, hopefully, but if you have a real downturn, like a period like the Depression was, there were a lot of utilities that ended up going bankrupt in the 30s. So,
one of the things you try to do is figure out if a company retains earnings, what is the rate of return internally. How do you do that where you can get a comfort level that this is something you can make a decision on?
Yeah, that's the tricky part, I think, in equity investing, because normally cash goes into two directions. One is a dividend, which you know what you have when you purchase the stock, and you have a pretty good handle on your reinvestment rate. So the wild card is what happens to the cash retained and reinvested for you by the management. And to the best of our ability, that is what we're projecting out in the future. And what we've noted is that businesses, there's certain central tendencies in businesses. Businesses that have high returns on tangible assets tend to be more predictable in most cases. And so like a Pepsi or a Procter & Gamble, if you look at their product mix, those are a lot of disposable, consumable goods. They're much easier to project out future cash flows than there would be on something like RIM or BlackBerry now, or Hewlett-Packard or something like that. Now let's talk about the investment strategy of purchasing price. The way we look at it is think of it in terms of a forward risk-adjusted rate of return. In other words, take into account the best you possibly can when you're looking at a business, the pieces. In most cases, you have a dividend, and you should know what the dividend is when you buy it, and you should have a pretty good handle on your reinvestment rate, historical reinvestment rate. So the wild card in investing is what the management does with the money, that when we've talked about those options. And that's the one that requires some effort. Now, that'll, in effect, what you'll end up with is starting to look at ranges of outcomes, because nobody can predict the future with absolute certainty. And the more predictable the business, the narrower the ranges, the less predictable, the wider the ranges. And that has implications also on sizing, because as your probability goes up and you feel more comfortable with the investment, both from a valuation and from a business model standpoint, the more money one should focus in on. And so the biggest holdings should be in the companies that where you have the most confidence in. So,
I mean, one of the things during the financial crisis that a number of value investors blew up, you did not blow up, but because they were focusing on like forward earnings, for instance, and they weren't focusing on what was going on with the balance sheet. They weren't looking at the creditworthiness of the company. They weren't looking at its need to access the capital markets, that they had sufficient cash on hand to continue to do their business, even if they couldn't basically borrow. So how did that figure in, and has that changed your thinking about how you look at companies at all?
Not really. I think the business model, understanding the business,
Right,
and what makes it tick is part of this process, because it all boils down to what you buy and what you pay for it. That's really the basic criteria of investing. And so, we'll adapt, though. I think that one of the things that we did very well is adapt to the environment. But again, if the focus point is continually on the best forward risk-adjusted rates of return,
right,
then you'll always be doing the best possible job you can within the limits of anything that the process is correct, but anybody who's using the process, it's sort of the old garbage in, garbage out. In other words, it's the process is great, but the input data, the assessment of business and price is the critical part of the process. But I think there's no substitute for knowledge and assessing risk correctly. We're not perfect. Nobody can predict the future with absolute certainty. But we are very adamant about controlling risk and for our clients to the best of our abilities.
You don't put that much emphasis on macro. You've said we can control the sails, but not the wind.
Correct.
Explain.
Well, I think it's a lot of fun to talk about the global economy or the U.S. economy or politics or taxes and all the rest. But so many of those things are beyond one's control. And so we think it's a lot better to focus on the things that one can control and adapt to the things one can't control.
And lessons. Bill Gates once said, success is a poor teacher. Failure is a painful but very real teacher. What setback did you feel you hurt, but you learned from it?
Well, it reminds me also what Will Rogers said. He said, good judgment comes from experience, and a lot of that comes from bad judgment. I think you do learn from major changes and from error more than probably from success. I think that's well said. I just think this business requires a lot of patience. I mean, I've made mistakes. If you can go back and look at them, and I think all of us have. So I won't claim to be perfect or anything close to it.
For those of us who might be personal sort of individual investors, what general advice do you have in terms of, protecting your wealth and maybe growing it?
Well, again, patience. I would highly emphasize patience. I think the other thing is find a strategy that you can live with and stick with it.
Okay, I hope you enjoyed this video. It took me pretty long time to get down to exactly what Don Yacktman investment philosophy and strategy was. He's very deep and he doesn't explain himself so good. I think he's a very smart and humble person, and he thinks everyone is also smart like him, so he doesn't really elaborate all his points very well. So I had to watch all these interviews a few times and read a few articles about him. I think I understood him, and I really liked it. It's another new point of view on value investing. Thank you very much, and I hope you enjoyed this video. Now, if you like this video, don't forget to smash the like button and to subscribe to the channel. Thank you very much.